Good morning. I'm Fenwick Huss, Dean of the Zicklin School of Business, and it's my pleasure to welcome you to today's webinar. Today, we explore the future of New York City's office market. Joining me from the Dean's office is Gwen Webb, Associate Dean, who will moderate the Q&A period. Today, we welcome Michael Morris, Vice Chairman of Newmark, and Steve Shigekawa, who is Managing Director for Neuberger Berman's Real Estate Securities Group. Leading the conversation, we welcome again today Larry Zicklin, former chairman of Neuberger Berman, our alum and benefactor, and I'm also pleased to tell you that Larry also teaches in our undergraduate honors program. Larry?
Thank you very much, Fenwick, and thank you, Steve and Michael. This is going to be some fun, I think. While our discussions are often free-ranging, my overall ambition today is to discover the state of the New York City office market at the moment, and considering the pandemic experience, how might it be different in the future? But let's begin with today. If you think it's fair, I'm going to use Manhattan as our barometer for office space, since that's where most of the offices are in New York. Michael, let me just start with you, and then we can go into a discussion. What is the vacancy rate now of offices, and what might it have been, or 2018 or 2019, prior to the pandemic?
Sure. So currently in Manhattan, it's approximately 18% availability rate. Availability includes listings of spaces that may be still occupied with expiring leases. And prior to the pandemic, 18-19, it was around 10%. We consider 10% approximately the hurdle or difference between a tenant market and a landlord market. E.g., if it's below 10%, it starts to get into a landlord market. And that's a summary of Manhattan overall, Larry. Obviously, we have different submarkets, and some perform better than others and are performing better than others within the city, i.e. downtown usually trails Midtown significantly.
Okay, so let's stay on that. And Steve, feel free anytime you feel like talking about this. How about the difference between the highest quality markets, the best buildings, the ones with the most amenities, and the secondary, or we used to call them B buildings? What is that difference?
Indeed, and we have a fascinating, further exacerbated tale of two cities, as it's being characterized by many in the industry here in New York. The new construction Class A buildings are leasing like wildfire with record-breaking rents. I think I mentioned to you the other day, a lease was just signed at the top of One Vanderbilt, which is brand new construction right next to Grand Central Station, for $300 per square foot.
But that's an anomaly, that, the top space.
The whole building, though, is going for well over $200 a foot.
Really?
And yeah. Some of the earlier leases were in the upper 180s, 190s. The building is nearly completely leased. Other buildings that are new construction are in similar vein in different submarkets throughout the city, whether it be buildings on 10th Avenue down in the Meatpacking District, buildings in the greater Times Square area. They're the newer construction buildings that are fully amenitized, have some shared outdoor space, are in some cases getting into bidding wars over tenants, whereas the B buildings, and yes, we still call them B buildings, in places like side streets in the Garment District, some of the outer lying areas of the city, older buildings that are downtown that are pre-war type of construction, those are having a very hard time. Ownership in those buildings are looking at different ways to compel tenants to look at their properties and lease vacant spaces, including the obvious, which is lowering the rent to reach the supply-demand equilibrium. But there's only so far they can lower the rent where it actually makes financial sense. They're not going to sign a long-term lease at a loss. It's better to leave it vacant and hope the market comes back. So there's a lot of capital being invested in these older properties to amenitize them and try to have them somewhat competitive with some of the newer properties.
Can you make an older property? I'm sorry, Steve, I apologize.
I look at the public companies, and those public companies generally skew towards higher quality buildings. And as a reference point, if you think of their occupancy levels currently are in the low 90% range. So with a vacancy of single digits. And so when you think about that versus what Michael mentioned as Manhattan vacancy being 18%, the public companies that, again, skew toward higher quality assets are, their properties are more fully occupied. So I think it's showing that that preference towards higher quality is beneficial, during this period of recovery.
Does it pay now to invest all the capital that's required to convert a lower priced a B building into an A building? And can you do it?
So you,
Well, I think it's a requirement in today's market. The tenants are looking for amenity-rich space. They want health and wellness. They want green buildings. They want amenities for meeting space, collaboration, food and beverage, in the building as well. And so these highly amenitized properties are what the largest tenants in the city are looking for. And so if you want to be competitive and you have an older building, it's going to require some type of redevelopment in order to attract those tenants.
so I completely agree with everything Steve said. A great example is a building like the Empire State Building. They have every amenity you can imagine under the sun. They have a conference center, a gym, that I would argue is better than any given Equinox, that's open to tenants, a private restaurant. They have really everything you could possibly imagine. And now they're looking at building a basketball court in the lower level to further compel tenants to lease space in their properties. And their rents are, in the $80 a square foot range, nowhere near the numbers that we're talking about for the brand new construction. But like Steve said, they need to do this to remain competitive and lease space. You cannot convert one of these older buildings to be a steel and glass building and a Class A building. You can invest the capital though to amenitize them and create a special experience that you would not have had before.
And can you take these old buildings and turn them into green buildings so that people within the building know they're breathing good air that's recirculating whatever number of times it should be recirculating, that has all the safety equipment that should be in a building to protect the tenants?
In short, yes. Yes, you can increase the MERV level of the filters. You can increase the air circulation, the fresh air. There are a multitude of ways to get to reduce carbon emissions, which is part of a new local law requirement, Local Law 97, which is big in the news right now as well, to reduce carbon footprints of commercial properties in Manhattan. But yes, they can.
And when you do this, can you give us an idea of what it costs to reconstitute a B building and make it as close to an A building as you can make it? Because I imagine the capital costs must be very high.
Well, when you talk about reconstituting it, there are a couple of different things. If we're talking about, we're developing the green approach, that's different from building to building. But arguably now they're finding that a lot more of the newer buildings are much more expensive to do this because there is so much glass, that so much sun comes in and heat, and a lot more power is required for things like air conditioning and to maintain the temperatures in the buildings. So arguably on the net neutral or zero carbon footprint, it's actually going to be more expensive for the newer buildings. To amenitize these older buildings, it's a case-by-case basis. It depends on the size of the building, depends on what other areas are available in the building. Some of these older buildings, they wedding cake or setback as you go up the building. A lot of those setbacks have been converted into what we're characterizing as activated now as outdoor space. And that has become a very prominent requirement of many companies nowadays, not just because of the pandemic, but because of quality of life. They want to have access to outdoor space. So it's a case-by-case basis, depends on the size and what level buildings are going through to create or going to commit to create that amenity center or quality center of shared amenities in the property.
And you could see these projects happening real time. If you walk down 6th Avenue or Park Avenue, or you go to the Penn Plaza district, you're seeing the buildings. They're reskinning the buildings, putting more efficient windows, and they're renovating the space because they needed to compete with that newly developed space, but also because the tenants want it. Prior to the pandemic, they wanted to be in green buildings. And I think because of the pandemic, it only just enhanced that. I mean, safety and clean air was even more important as a way to make employees feel comfortable coming back into the office.
I remember when we moved our headquarters at Neuberger Berman from 3rd Avenue to 6th Avenue, one of the reasons we moved is that we were in an older building. The landlords wanted to refurbish it, but we didn't want to live through all that refurbishing of the HVAC, the skinning, the windows, God knows what else was going to go on, the safety precautions that would have to be put in. And we decided it was easier to move. I imagine that's a factor also. The tenants don't want to be there during this process, this conversion process.
Yeah, that's definitely the case. I think as you've seen new development in the Midtown South area, you've seen large tenants move to new buildings. When they're backfilling the older building, the building that they're exiting, that's oftentimes a good time to do these redevelopment projects. And for Neuberger, you're exactly right. I think we didn't want to go through 2 years of having to shift floors while they renovated. But you're seeing as large tenants move out, it's an opportune time to do these redevelopments.
Yeah, to point to something Steve said earlier too, in a lot of cases, it's a necessity in vacant buildings or highly vacant buildings in order to compete and lease their available space.
Well, I want to go back to the rental rates. When you talk about 80, 100, 200, up to 300, which I understand is an anomaly at 300. Who are the tenants taking this? I don't mean the names of the companies, but I'm assuming that only tech companies can afford to pay these kinds of rents. Is that unfair?
It's not completely accurate. You have hedge funds, different financial services firms, institutional organizations that are not service companies that have assets that found for the first time in 13 years a down market. As high as those rents sound, they are down compared to where the market was going and trending. And they are going to be around long term. They're not small businesses, the vast majority of them. And it is other groups too. Buildings like One Vanderbilt, it's not tech firms. Buildings like the Farley Post Office, where Facebook just leased 800,000 feet. Yes, obviously a tech firm. Now, and you have Google, who's constantly looking at buying, believes in the value of owning the real estate because their cost of capital is so low. Who's bought over 2 million square feet of office space in the last 2 years and plans to populate it over the next 6 to 12 months.
Is Google an anomaly, or are other large corporations thinking of buying their space?
So they are, I would say, generally speaking, they're an anomaly. Amazon has purchased the Lord & Taylor building, but generally speaking, they are in Manhattan an anomaly. Maybe more unique, I would say. Sorry, go ahead, Steve.
For most companies, the capital expense of owning the building may not make sense. It's better to have to lease a property and use that capital for your core business. Historically, New York, we've always viewed it as a financial services industry, and as Michael mentioned, the largest technology companies are looking at the New York City market as a place where the talent is and where they want to have this convergence of technology and media and all the social media aspects that we see in technology. So the technology sector has been an important sector for the office market, for even, prior to the pandemic, the technology companies were coming. But there's also healthcare and life science and other industries that are looking for high quality space and are able to pay premium rent.
When you say life sciences, are we talking the hospitals now?
In some cases, it's biotech companies, it's pharmaceutical companies. I always think of life science space as a combination of office and lab space. Oftentimes, it's around these medical facilities. And so where there's clusters of university research and hospitals, that's a good place for the pharma and biotech industry to find the talent, and they're looking for space in those locations. And when you think of it from a pandemic perspective and the whole work from home that we've thought about, having a life science tenant where you have lab space next to your office space, you can't replicate the lab at your home. So having a life science tenant is is something that I think landlords really appreciate. But that sector is one that, New York is a center for hospitals and medical research. And so finding the talent and the research capabilities in this market is what's attracting, pharmaceutical and biotech type companies.
I would think a lab tenant would be a fabulous tenant because you can't move a lab so easily, and it has to be FDA approved when you move it, which I would assume no pharmaceutical company would like to do given a choice. Is that a fair assumption?
Yeah, historically, life science has been clustered around markets like Cambridge and South San Francisco and San Diego. But New York, I think the vast amount of research and medical facilities here, is attracting the landlords. And you're absolutely right. Having the lab space that can't be replicated in another location on a remote basis means that you have stickier tenants and ones that are going to be putting in a lot of things inside of the office that would be difficult to relocate. And so you have that stickiness of a tenant. So from a landlord's perspective, I think a large life science tenant is very attractive.
They are. It does require a tremendous amount of capital, Larry, to redevelop a building,
Sure.
let alone build. But what's going on in Manhattan is conversion, other than the Alexandria developments. But there's a building on West End Avenue and Park Avenue South. They're spending tremendous amount of capital that they may not find tenants for. So yes, once the tenant is there, is it incredibly sticky? Absolutely. And do you typically get caliber credit of tenants that are institutional grade? Absolutely. The question is there enough demand for that space? And we're seeing that play out over the next couple of years in New York.
Historically, it's been my impression that the financial industry, broadly defined, has been an enormous user of space in Manhattan. I read in recent months that JP Morgan, Citibank, Wells Fargo, Bank of America are all downsizing and giving up space. Are the numbers meaningful?
The numbers are meaningful, but what's happening over time is the reduction from some of those firms is being subsidized by not only the growth of a lot of the FANG and related tech companies and services related to tech companies, but also some of the other financial services groups like a Citadel, who's growing incredibly right now. There are, for all the ones that are downsizing, the old institutional names, there are others that are growing to gobble up what's been subsidized or what's been downsized, excuse me. The vast majority of leasing over the pandemic in millions of square feet was tech companies. Their demographic is extremely different than the demographic of older institutional financial services companies, right? They're younger, they're looking for more social interaction, they're looking to meet mentors, they're looking for these amenities, they're looking to collaborate on projects. They also may live locally in a small home or with their parents, and the office may be a haven. A lot of these large tech companies offer multiple meals, they have showers, fitness centers, and they have a lot of employees that want to come in 6-7 days a week, not just 5 days a week. It's a vast divergence from the folks that are talking about, can I work from home, or where am I more productive, et cetera.
Does a tech company require as much space, and I don't know what the metric should be per dollar of revenue or per number of employee, as other companies, because so much of their work can still be done from home, which is why I guess we're seeing the value of suburban homes rise in price so dramatically as it has in the past year or two.
So
it's interesting.
Oh, go ahead,
on
Steve.
the work from home end, you're right. The technology companies have been, having more of their employees work from home for longer. But at the same time, those companies are growing, and they've signed some of the largest leases even during the pandemic. So I think it's not so much how much square footage per employee, but where the growth is in terms of their businesses. So the largest technology companies are hiring people, not just in New York, but in their other locations as well, and it's showing up. So even though many of them Many of the technology companies have been the slowest to return to office, even in a hybrid model, but they continue to sign large leases in Manhattan.
So by way of example, obviously, Roku signed a 250,000 square foot lease over the pandemic in Times Square. Same with TikTok, 250,000 square feet. Apple expansion, 400,000 square feet into Penn Plaza. The list goes on and on, Larry. The reality is, though, it's very different than the approach on back to the office. It's the employees and folks that work at the company at different levels that want to come to the office. And these companies are spending a tremendous amount of capital to make it exciting to come back to the office. They're not mandating it. It's very different than, a 40 or 50 something year old that can work from home, knows what their job is, knows what they do every day, has their relationships in the office, and their career path is somewhat set, trying to convert to a hybrid model. It's just a very, very different approach. And what you'll see with a lot of these growing tech companies, and that's part of why they're not all back to the office, is because they're letting the employees determine it, but they're trying to make it exciting to come back to the office, and they are.
What about professional services, the law firms, the accounting firms?
Before we move on to that, one other thing I would say about the tech firms is a lot of the work from home jobs, they are hired as work from home jobs. They're not people that were hired as planning on coming to the office and changing to a work from home. They were hired from Oklahoma at a different salary, different cost basis, different benefits, and hired as a remote worker. Just want to make sure that that's clear. It's not a lot of these, suburban 25-year-olds and 30-year-olds that were commuting to the office that say, now I want to work from home and live in my studio and work there all day.
So are we bifurcating this now by age? And obviously this is not absolute, but will many older employees continue to work from home where they can, service industries, and many of the younger people who are, as you say, living in a parent's house or in a studio, want to go to the office as a relief?
Anecdotally speaking, we're seeing a lot of that. It's more than a relief. It's exciting to go to the office. They get 3 meals. They get to meet people, make friends, mentors, and have a career path instead of from one gentleman, he said, I don't want to live under a rock, and everyone else, all my peers are excelling in their careers and meeting people and getting married, and here I am hiding in my studio for the next 20 years. So it's a very different approach than somebody who's got 3 children and we're concerned about schools and needs more space, and has an established career. But we are seeing it with the service firms. The law firms are much slower to come back, and a lot of them can work remotely and do the exact same work that they were doing in person. And we see it a lot with a lot of the older banking groups and insurance companies. Absolutely. But those industries are also prevalent amongst a different demographic of individuals and employees as well. Age is part of it, but it's by no means the driving factor.
Got it. How quickly is space coming online in the next 2 or 3 years? Is there a lot of square footage coming online?
There is not as much as has come online before. A number of projects have been tabled. Some of them are moving a little more slowly. We're also seeing construction slow down dramatically because of logistics and supply chain challenges, as well as labor challenges. Steve, I think you track some statistics of what's coming online in the next couple of years.
Yeah, I think, I talked to some of the largest, office owners of office, and you have to remember that the New York office market it's obviously the largest in the country, somewhere in the 400 million square foot range, and so every year you're going to have obsolescence of older buildings, and maybe that's going to accelerate because people want higher quality. But you're always going to have a certain amount of new construction coming into the market. When you do have large projects coming online, whether it's Hudson Yards or new headquarters on Park Avenue, those get the headlines. But you always need that new construction just in terms of the market growing and replacing older assets. In previous cycles, we've seen some of those B and C quality office buildings get converted. If you look downtown 20 years ago, many of the space that was financial services office is now residential. So some of that construction, is replacing some of that space that is no longer in the market. So downtown, there's a vibrant residential market downtown where 20 years ago maybe was less so the case. We also saw hotels offices being converted to hotels. So that was a trend that took place. So when we're looking at the market today, we see that tenants and employees want high quality, new, redeveloped assets. There's going to be B and C quality office buildings that there's likely to be a better use for those assets. So you do need some new construction to facilitate that transition, and some of those older office buildings get converted to other uses.
Well, let me ask
And
you
a good example,
Yeah.
actually, a very good example
Please.
is, I'm sure many folks are familiar with the old Credit Suisse buildings on Madison, down by Madison Square Park. They took the old building down to shell and core and are building a tower on top of it. It's not going to be finished for another 18 to 24 months. And they already have leases out for about 85% of the building at healthy rental numbers. That building is a great example of an older building that's going to be completely renovated and an additional new glass and steel tower on top that is replacing older construction. Same thing's happening in Penn Plaza with really two Penn Plaza, or Penn 2 as they're calling it now. They've stripped down the building, vacated the vast majority of the tenants, putting a new skin on, they're creating a whole plaza and closing the street to connect it to Penn 1 and a whole little park there. And there are plans for the other buildings in the area as well that Vornado has publicized. So this is happening. It will continue to happen. The population growth will continue to happen. There's a tremendous demand for talent here, in addition to the talent that's already here. And we see it continue to grow, and this just to be another down cycle as the last dozen were.
Yeah, but the question that I'd like to get to when you use the term another down cycle, and I realize we've been through a lot of down cycles, although the last one was what, 2008-9?
Yeah, financial crisis, yeah.
Yeah, financial crisis. Is this different because of the technology? Technology is so good now that you can do many things from home or from an office in Des Moines that you could never do before. When you think of Zoom and you think of DocuSign and you think of WebEx and a million other technologies, it seems to me on the margin, the need for an office is diminished. It's not extinguished, but it's diminished. Is that fair?
Yeah, I think this cycle, that's what participants are trying to figure out, is that what are the additional challenges? We've always had a shift from urban to suburban. I would say prior to the pandemic, there was actually a shift back to urban, people wanting to live and work in the cities. Obviously, the pandemic.
Hang on a second. I'm going to mute myself.
Okay. So we've had that. The pandemic has also highlighted some of the shifts away from coastal markets, whether it's California companies moving to Texas or New York companies moving to Florida. Those trends have been similar to what we've seen in the past, maybe accelerated. What you mentioned, the technology and the ability to work from home, that's an important dynamic this cycle that we're trying to figure out. If the office market moves to 3 days a week or 4 days a week of people being in the office, that's just going to make the recovery from 18% vacancy to 10% vacancy take a little bit longer. And so those are the things that we're concerned about. In terms of what hybrid and working from home has allowed, and the technology has allowed, is to people to think about what I would say is one of the more important factors is commuting and commuting time. When people look at they live in the suburbs, and to come into the city on Metro North or Long Island Railroad, you're spending 2+ hours a day commuting. And if you can avoid that, because of technology, that's something that we think if people want, is they want that flexibility. So technology is allowing that. And the question is, to what extent is it going to slow what would be a normal recovery in office fundamentals?
So I'll add an additional perspective on everything Steve just mentioned as well. These technologies, WebEx, Zoom, they've been around for a decade. Tech firms are completely aware of them. What's changed now is the DocuSign. I don't know the exact date, but it's been around for a long time. We've been using it for a very long time on real estate contracts. Tech firms are extremely intimate with these tools. What's happened is the awareness of across all different industries, and especially in the service sector, of these tools has changed. And you have a lot of different services that are now being provided via these platforms. So they are changing the perspective from a demographic that was not aware of them. But again, as I mentioned earlier, a lot of tech firms have hired remote jobs and they're marketed that way. And these tools are utilized for years way before the pandemic. But what is potentially going to change for some time, right? As the fact now that everyone's aware of these technologies, is there are folks that can do their jobs remotely and can be more efficient, as Steve just mentioned. But what also we don't talk about with technology is everyone who commutes and is on a subway or a train or a bus and doesn't see someone on their iPhone or their Samsung or their device. That time on the trains and the commute time, people are working now. They're getting a lot done. Forget about laptops. They're getting a lot done that they never used to be able to. It's not just a phone call now. So that's making a lot of that commute time much more efficient. And it already has been doing that for years. Did this take it a little bit sideways with the pandemic? Of course. But that time was being utilized. It wasn't as if people were commuting and they were locked off all devices and everyone was frozen and couldn't do a single thing on the train.
Yeah. So I guess the summary of that question would be, has the pandemic altered the office market for years to come? Is it going to be forever changed in some way or other that maybe we don't even know right now?
I would say to speak in perpetuity would be, I'd be naive to try and make that assessment, but or speculation. What I would say is there are certain things about or certain aspects of office that are definitely changed for now. Candidly, it's not necessarily something that wasn't. It's difficult to discern whether or not it's 100% correlated to the pandemic, but the driver for access to outdoor space and improved quality of life, at the very least, seems anecdotally connected to the pandemic and people's perspectives on the value of their time and their experiences in the workday. The desire for social collaboration has also increased dramatically due to what we're calling pandemic fatigue. We're seeing people, restaurants everywhere there's much more demand to be outside and to be with others because they've been locked up for a year or two as well.
I think the question is still open. I mean, if you look at a parallel to the retail market and how much technology has impacted retail, we've seen a huge transition because of e-commerce, because of being able to have things delivered directly to your home. That's impacted the retail market. Not sure if technology is going to have as big of an impact on the office market, but we have had a 2-year experiment where people have worked from home. They've been productive. There could be questions about that productivity, but we've done it for 2 years now. And so I think for a lot of employees and workers, it's been somewhat eye-opening. Is the technology, virtual networks, cloud computing, 5G technology has allowed you to do Zoom calls and to do them efficiently without cutting out frequently. I mean, obviously we still have Zoom issues here and there, but 2 plus years ago, I'd say the majority of people didn't know how to do a Zoom call. and didn't know how to effectively work from home. And so, you've seen people convert their home office is now being utilized, and they're seeing the benefits of being able to have the flexibility to work from home a couple of days a week. Well, they've actually been doing it for 5 days a week, but maybe the future is coming to sort of this hybrid model where you'll be allowed to work remotely 1 or 2 days a week, and that's a change that is likely to stick around.
There's also a very interesting phenomena going on, Larry, and I don't think we've talked about this at all, and it's just beginning. And what we're seeing is, because everyone feels that everyone is reachable via technology, and that people, it's not very clear when they're on vacation, when they're off, when they're on a sick day, when they're fully available, there's a lot of anxiety from a lot of employees, and it's very anecdotal, the information at this point, that they don't feel like they can really get away. They can't really turn off. There's an expectation from their managers that they're always available now because they don't come to the office, so not sure where to draw the lines, and these lines are getting blurred very heavily and causing a lot of stress and challenges in the workplace. You're on mute, Larry.
It's because I got a banging in construction upstairs. But I just want to make a point. And my numbers are a little old now, but there was a time a number of years ago where the number of Zoom calls was like 40 million a day. It's now 400 million a day. The last I remember of people on Zoom at one point or another during the day. So the world has changed in some way that I don't understand. But I want to get to a point that Gwen raised a little earlier from a member of our audience. And that is the aspect of long-term leases that people have signed and suddenly find themselves in a position where they don't need as much space because of the pandemic, perhaps because of $125 oil, for all I know, because of who knows what reason. What kind of accommodations or modifications are landlords making for those kinds of people?
So at a very high level, landlords are making accommodations that make sense for landlords, as they always will in any situation. So what does that really mean? Well, it depends on any given specific situation. Pandemic aside, we're often engaged to restructure leases, renegotiate them. There's always the opportunity, the end be all, if you can't figure something out with the landlord, to put the space on the market for sublease at compelling numbers with compelling incentives. But it really depends on the specifics of the tenant requirements, of the landlord requirements. If the landlord has another company that's growing in the building and it's spectacular space and there's nothing else available, of course the landlord's going to be accommodating. If the landlord has a building that's 50% empty and he or she is barely making their debt payments, he's not going to there's not much latitude. So it's like anything else. It's a negotiation. It depends on the specific landscape and what the opportunities look like to create a win-win scenario, if there can be one created.
All right, I want to move it to Steve for 1 second. Steve, you do a lot of research on public companies. In a prior conversation, and if I'm misstating your position, please correct me. I think you mentioned to me that the REITs are selling for less than whatever the underlying value that companies think their buildings are worth, that there's a discount on the public market. If that's true, how do you explain it?
Yeah, I think when, in the public market, we can invest across 15 plus different types of properties, whether it's hotels or residential or data centers or office. For most of the sectors, we've seen a recovery through the pandemic. So in some sectors that have actually benefited, whether it's a data center company or some of the residential companies, they're trading above where they were prior to the pandemic. There are some sectors that have been more challenged through the pandemic: hotels, retail, and to some degree office. And so this whole question of work from home, hybrid, seems to be in the public market still one of the biggest questions. The office sector is trading at roughly a 30% discount to net asset value. and when we look at net asset value, we're looking at what is the value of the underlying buildings if you were to sell them. So looking at the price of the shares, the price of the company in terms of per share relative to the value on a per share basis of the actual asset. And so the office sector is trading at the widest discount, and within office, New York office is trading at the widest discount. So if office is trading at a 30% discount, New York office is trading in some cases at 40+% discount to the private market value. So there, in the public market, there is this question of what is the future of the office market, especially relative to alternatives in real estate that you can be investing in. And so you're right that the office companies, and particularly New York office companies, are trading at the widest discounts to the private market value.
That's an enormous discount.
Yeah, and I think what we're looking for over the coming months and years is as people come back into the office, as we get to a post-pandemic world, you know, what is that going to look like? I think over the next couple months, you'll start to see physical occupancy or attendance of office workers back in the city continue to increase. Michael and I, we track things like ridership on commuter rails. We track scans into the building, and we're looking for that point where we get back to people coming back into the office. They're going back to do do retail shopping. They're doing the entertainment. They're going to restaurants, but we haven't seen physical occupancy in office locations return to pre-pandemic levels, and so that's creating some uncertainty. But the more we see people come back to city centers like New York or San Francisco, you know, that discount, you know, we think would narrow. Obviously, there are other issues in play. You know, the relative value of a market like New York versus the Sunbelt market that has performed better over the past few years. You know, you're seeing that what was normally the spread between those markets narrow. But we think as people start to come back into the city, that you'll see that discount narrow. More transactions, more visibility on sales of office buildings gives us more information as to whether the market is forecasting that perhaps the private market values are too high, or is it just the uncertainty and that prices of publicly traded office companies will narrow that discount to the private market value? But that's a primary question for us.
Is it unfair to ask you, Steve, if you're using some of the cash at your disposal to buy into these discounts?
You know, we're underweight the office sector, but the office names that we own skew toward higher quality buildings, higher quality portfolios, and we think those will be the winners in the sector. So while we still think that there are good in many cases better opportunities in other sectors, we do have exposure to office, but it's skewed more toward higher quality ones that we think are going to get, you know, will be able to increase their market share in terms of filling up their buildings. So similar to what we've been talking about, you know, we want to find high quality assets, ones that have that amenity rich space. But it's going to take time for the recovery. I think the start of this call, we said 18% vacancy in the New York market. You know, that's going to take time to you know, get back to a more normal space. But there are opportunities if you are very optimistic that we're moving to a 5 days a week back in the office for everyone as it was pre-pandemic. There is a good opportunity in the public market to own New York office.
I want to ask you this question, Michael. Given this 18% vacancy rate that Steve just mentioned, And given the skewing toward the lesser quality buildings, the B buildings, as we discussed, are there going to be some problems with some of these landlords, or is this space in such good hands that there's no worry that we're going to see bankruptcies?
No, there will likely be some buildings lost. Building bankruptcy is tough to say. The buildings are all owned by shell entities, so the buildings are their own world in themselves. But B buildings that can't make payments for a long time, there are issues. Now keep in mind, banks don't want the buildings back either, so they're extremely comfortable working things out with these owners because they'll be in worse shape if they get the building.
To go back to the hybrid workspace for just one more minute, assuming in the future, which is a great assumption, that 20 or 25% of the working hours are now worked from home, will that change the amount of space that's required? Will there be hot desks? Will there be people coming in Tuesday and Thursdays and other ones coming in Monday, Wednesday, Friday? Are we going to see this change in the way we use office space?
We believe that we were already, well, we know we're already seeing it, and it will likely continue. It'll be a different option and model for many companies. There's no question that the 3 most demanded days right now, and it's obvious, are Tuesday, Wednesday, Thursday. There are different approaches being taken by different companies and cultures that are hot desking, some that are requiring people to have, most folks want their own desk and their own private space, or personal space, I should say. It's not that private anymore, but personal space. And they're being required to come to the office, I'll say X amount of days, depending on the company. Some companies that have a low margin business are very happy to try and figure out a way to have everyone work from home, right? And they're out there. There's really the gamut. So I think we're going to see it for a long time. Who knows about forever, but for a long time, we are going to continue to see these hybrid models where I speculate Friday is going to be the most challenging day, as it was even before the pandemic, to get everyone into the office. Now it's just going to be even less people. And while there's such demand for talent, the talent can really call the shots as to what their requirements are. I think we all hear these stories of people who are very well, have a great pedigree and great experience that are heavily desired by top tier firms, where it's not just a matter of how much they're getting paid, it's a matter of their quality of life, and they want to work from home on Mondays and Fridays, and they're going to make that part of their package. So yes.
I have a friend who's a partner, a managing partner, and he made the case that his partners want to come in 1 day a week, but they want their own space and they want their own office, and it's going to be kept vacant for 4 days. I'm sorry, Steve, you had something.
Yeah, I think the other aspect is, Michael's absolutely right. People generally don't want a hot desk and they want their own space. Whether I'm in 3 days a week or 5 days a week, I still want my own personal space. One of the things that we're worried about is some of the amenities. If you think about, if you say 20 to 25% fewer people coming into the city every week, that's less people buying train tickets, buying subway tickets, less people eating at restaurants, that's less people getting shoe shines, going to the drugstore. And it's all of the services businesses that are going to have to adapt to that. I think there was an article in today's paper talking about transportation and how are transit authorities adapting to people that don't want to buy a monthly pass because they're not coming in 5 days a week. They're only coming in 3 days a week. And so they're going to have to reprice that and change service schedules and employment trends. So some of those services are going to be impacted by that 20 or 25% fewer workers in the city, if that ends up being the case.
I'm going to turn it over to Gwen, but before I do, maybe we should have another session one day about retail and service and the implications of all this on those industries. I'm sorry, Gwen.
Oh, it's fine. Thank you all. There are quite a few questions, more than we'll be able to get to, but one was on greenwashing. Do you see greenwashing in real estate projects? And if you do, are there any regulations in place that would control that?
I can start on that. I mean, obviously, greenwashing is something that everyone's concerned with, just because environmental is an area that we're talking about increasingly. I would say within the real estate world, tenants are demanding their building, and there are regulations and there are governing bodies that are tracking that. So when we look at the quality of buildings, we look at the certification of those changes they've made to the building, whether it's air quality, greenhouse gas emissions, use of solar. All of those things are regulated, and so but that's been part of real estate and real estate development for even prior to the pandemic.
Well prior to the
People want
pandemic.
to clean buildings. Yes.
Yeah, social responsibility, and the buildings get certifications at all different levels depending on how many of those criteria that Steve just mentioned, what they fulfill.
All right, we have another quicker question here, and the question deals with B or C quality buildings. Do you see, can you give examples of conversions that you've seen or restructurings that you've seen for those buildings? And in particular, the questioner asked, have you seen any of them being converted into data centers?
We do not see them being converted into data centers. New York, their data center its data center focus really kind of fell apart after Hurricane Sandy. The vast majority of data centers, third-party operated data centers and co-location facilities in the tri-state area is in New Jersey, and there are a couple in Connecticut and northern New York, but the vast majority is in New Jersey. All of the exchanges, they're not here anymore. They're all in New Jersey. New York Stock Exchange, NASDAQ, all in New Jersey, where all trades get fulfilled. Manhattan is, between fuel supply, geographic and geopolitical dangers, and there's just a host of reasons why Manhattan is the wrong place for data centers.
All right, I think we'll leave it at that. Michael, here's a question for you. You have an MBA from Baruch. You're a successful real estate broker in New York City. Speaking now to current Baruch students, what advice would you give them interested in careers in real estate?
So at a very high level, careers in real estate includes a tremendous range of different types of focuses. Something that I've learned over the years is that there are even roles and opportunities in the most minute sectors of the industry. So I would recommend getting a good overall perspective of the different types of careers that are in industries. Obviously, Steve and I are in very different sectors, but we're both involved in real estate. And I would also say, go to school, get your secondary degree, get a graduate degree, get an MBA, get an MS. It's invaluable. And I think we're seeing that throughout the country right now. A lot of folks are going back to school.
Let's give a shout out to the Newman Department of Real Estate here in the Zicklin School of Business. Steve, we have a question for you here. You are Senior Portfolio Manager for Neuberger Berman's Real Estate Securities Group. What advice would you give investors over and above the traditional advice that they should be including real estate securities in a diversified portfolio?
Yeah, I think it's clear that owning real estate is a good way to get, strong performance. It helps diversify equities, fixed income. I think in the current environment, one of the questions we often get is, in an inflationary environment, how can real estate help a portfolio? And what we found is that real estate historically has been a good hedge to inflation. Keep in mind that the primary metric, CPI, about a third of that is owner equivalent rent. So as rents are going up on the residential market, that's a key component to CPI. So, I think that helps as well. Within the public market, I remind people that the public companies are often the largest owners of real estate. They own the highest quality portfolios, and they have the best balance sheets. So if you're concerned about higher interest rates and the pressure that puts on real estate owners, the public companies generally have the lowest amount of leverage, the lowest cost of capital, and is therefore, we think, a good way to get that real estate exposure through the public market.
Thank you.
If I can just interject for a second, over the last 4 or 5 years, have there been an enormous number of refinancings where some of these building owners might have taken on a little more than they can handle, given what's happened with this 18% vacancy rate?
It's even pre the 18%. With interest rates being so low, there's been a tremendous amount of recaps going on. In a lot of cases, multiple times in the same properties over the last 4 or 5 years.
And do they always borrow as much as they can possibly borrow from the lender?
No, it depends on the specific scenario. I'm sure Steve has more statistical information on that, but from my experience and perspective, vantage point, it depends on the particular project, and if it's just about money and getting a lower cost on their debt, or it's about something different.
I think borrowers and lenders learned a lesson during the global financial crisis, that too much leverage is dangerous. At least in the public market, the average leverage level pre-global financial crisis was much higher than it is in the public market today. And I think that carries over into the private market. But there's also capital is readily available, not only from the banking sector, but from private providers of capital. Investors are looking for yield, and so oftentimes that's tempting to add more leverage. But I think generally borrowers and lenders have learned that lesson in the financial crisis.
All right, thank you. I think we have time for just one last question, and this one is for you, Larry. Having heard Michael's and Steve's insights on the future of the New York City office market, what innovations and changes do you think are the most likely to change how employers and employees relate to each other? And is this going to be for good or for bad?
Well, obviously I can't see the future any better than anybody else, but we're going to have to adjust, I believe, to a new world. And the new world is, to whatever extent is true, people aren't coming to the office as frequently as they used to. I don't know the numbers. I don't think there'll be as many hours spent in the office. Technology only gets better. And I would assume the real estate industry, as every other industry, is going to have to adjust to the new technology and make use of it. And they're going to have to facilitate the use of technology, making their buildings more friendly to technology. And what I think both Steve and Michael talked about, putting amenities in, will be helpful. But in the end, I think we're going to lose some number of hours spent in offices. I think the Long Island Railroad and Metro North are going to lose a certain number of passengers. I think $125 oil will change a little bit about the way people commute by car. The world is ever changing, and the industry has to react.
I think we'll leave it there. I want to thank you, Larry, Steve, and Michael, for your comments. A very, very engaging conversation. Please join us on our next webinar on April 12th. The title is, what are the key risks facing global banks and how will they manage them? Joining Larry will be Lisa Farkowitz, Managing Director and Head of Risk Modeling at Barclays, and our own Professor Ken Abbott from the Law Department. So thank you all, Larry, Steve, and Michael.
Thank you,
everyone.
everybody.
Thank you.